Welcome to today's podcast. I'm Pat Soldano, President of Family Enterprise USA and Policy and Taxation Group. If you don't know who we are, we advocate for family-owned businesses, all sizes and all industries, on tax and economic issues that affect the families of those businesses, as well as successful individuals and family offices in the United States at a national level in Washington, D.C. Today, we're delighted to have with us Russ Sullivan of the Brownstein law firm and Michael Hawthorne of the Squire, Patton, Boggs law firm. Both of them are based in Washington, D.C. So Russ is one of the leading tax policy experts in our nation's capital. He's the chair of the National Tax Policy Group at Brownstein, and he provides insight into legislative and regulatory risks and opportunities related to tax policy. Russ is a Capitol Hill veteran, as I well know, because we spent a lot of time together in the last 2 decades. He spent over 14 years with the Senate Finance Committee, including 9 as the staff director. During his time to Senate Finance, Russ worked directly on policy matters related to the estate tax. He served as chief tax counsel under Senator Boggs when the committee passed legislation repealing the estate tax in 2001. A decade later, as a committee staff director, Russ worked with a bipartisan group of senators to make a reduction in the estate tax rate and an increase in the exemption permanent. I also want to welcome Michael Hawthorne. He was an associate of Squire, Patton, Boggs public policy practice. He has a great deal of experience on Capitol Hill and government investigation experiences. He advises major corporations, organizations, and nonprofits on complex policy issues with an emphasis on taxation, energy, transportation, and infrastructure. Prior to joining Squire, Patton, Boggs, Michael developed a strong background in public policy and congressional procedure, serving as a law clerk for the U.S. House Committee Ways and Means and a senior member of the U.S. Senate Finance Committee. So welcome to both of you. Really appreciate both of you doing this podcast with us today. Well, let's get right into it. Everybody wants to know what's happening with the one big bill. It is referred to as H.R. 1. It is an extension and maybe more of a modification on the prior 2017 Tax Cuts and Jobs Act. So, Michael, why don't you start off and tell us where we are?
Thank you, Pat. Yes, as I'm sure you and many of the listeners have seen, just last week, the House narrowly advanced its version of the One Big Beautiful Bill Act, H.R. 1. It's a multi-trillion-dollar spending and tax package, and they advanced the bill prior to House Republicans' self-imposed deadline of Memorial Day. H.R. 1 is now before the Senate officially. Congress is on recess this week for the Memorial Day holiday, but Senate Republicans are already considering their own legislative proposals and commenting on the bill. We expect that process will continue in earnest over the next few weeks. So we're still in the early innings here of extension of TCJA, but Congress, as of this week, has officially cleared its first major legislative hurdle of the bill.
Maybe, Russ, you could address on the Senate side, where is the bill in the Senate?
So the bill's not in the Senate yet. There have been no markups anywhere. How it works is the bill from the House will be sent over to the Senate, and at that point, the Senate has a choice. They can start and mark up in the various committees that have been authorized to write portions of this so-called reconciliation bill, the One Big Beautiful Bill, or they actually could skip committees and go straight to the Senate floor. That decision has not been made yet, and it will be made based on really the composition of committees. In some committees in the Senate, there's just a 1-vote margin. It's 14 Republicans and 13 Democrats, or 12 Republicans and 11 Democrats. And so if you have someone on your committee who's not going to vote for the bill and you're a Republican, that makes it problematic to mark up in committee. So we might see some committees mark up, others not, or we could see none of the committees with a formal markup and combine it into a bill that then becomes a substitute on the Senate floor.
So, Russ, what do you think some of the stumbling blocks might be to this bill? You know, the president has asked to get it to his desk as soon as possible, and they seem to be moving, as both of you indicated, pretty quickly. But what do you see as some of the stumbling blocks?
Well, first of all, the Senate has different rules than the House does. I think if you ask most Americans, whether the two chambers in our Congress operate differently. They might say, no, they don't. They operate the same. But in fact, they don't. In the Senate, in order to pass any legislation, the general rule is you have to have 60% or 60 senators out of 100 to vote to close debate on the bill. That's the general rule. There are exceptions for certain nominations, there are exceptions for certain treaties, and there's also an exception for the budget-related legislation. Whereas if you pass a budget resolution, you get one bill called a reconciliation bill, where it only takes 51 votes to pass a bill in the Senate. And that's the process that Republicans have chosen to follow because they're really not sure they could get a significant number of Democrats to vote for the same bill that the Republicans want to vote for.
So, Michael, do you have any additional stumbling blocks that you see could be happening with this bill passage?
Sure. So believe it or not, even though the bill has cleared its first hurdle in the House, even though it was a narrow vote, the bill likely will have to go back to the House again. As Russ mentioned, the Senate will include a substitute amendment and make changes to some of the House passed provisions. So there's a 3-vote margin in the House of Representatives at the moment, and there are still some lingering disagreements between House Republicans and Senate Republicans on how to tackle major portions of the bill, like the state and local tax deduction cap, repeals or modifications to Inflation Reduction Act, clean energy tax credits. So depending on how the Senate makes changes to the bill, that may influence House Republicans who will once again have to vote on those changes. And I think the Senate is aware of those kind of limitations in that small majority in the House, and the fractious House Republican conference between conservative members and more moderate members who are seeking different priorities in the bill. So even though the bill is soon to be in the Senate, I think the House could once again be a stumbling block towards final passage.
But Michael, before it gets there, the Senate has to do that same battle on a lot of those issues just within themselves.
Correct.
For example, there are some senators who really think the House went too far on the Medicaid cuts, and they want to scale those back to ensure that they're not reducing benefits for eligible individuals. But there's another group of Republicans who really believe that the House bill didn't contain enough spending cuts. We've seen Ron Johnson make some statements over the last few days, and he claims that there are at least 4 senators who believe as he does. So they're probably going to come forward with some additional spending cuts ideas. They might be Medicaid, but they might be other things. If they're going to reach agreement on the whole bill, it's more likely, in my view, that they'll be able to reach agreement on some other things rather than more Medicaid cuts. But as you said, the Senate, the members don't care so much about the individual SALT cap because there are no states where that has a dramatic impact, like New York, New Jersey, Illinois, California, that have any Republican senators. So It's just Republican senators going to vote on this bill. You need a Republican senator from a state that has high state and local taxes, and that compared to those states I mentioned already just doesn't exist. But that doesn't mean that the Senate's going to eliminate raising the SALT cap from 10,000 to 40,000. They may leave it at 40,000 because of the very thing you just said about the Senate has to think about whether the House will be able to approve what the Senate bill looks like once they get finished modifying it. Don't you agree?
I agree, and oftentimes it's usually the reverse. In 2017, there was 240 House Republicans who were working on their version of the House bill, and they had a smaller working majority in the Senate. So it's definitely inconsistent with historical examples. Now we have a larger Senate majority in the Senate that has to deal with House constraints.
Yeah, and you're exactly right. And at the beginning of this year, when they first took office, there were some Republican senators who said, well, we've got a 3-vote margin in the Senate 3 out of 100. That's much larger proportionally than the 3 of the House, where there's 435 members. So there were some Republicans who even thought, well, we may just have to take whatever the House can pass. But over time, that view has eroded, and now I think it's clear the Senate will make some changes to this bill.
Well, so you both had talked a little bit about these procedures, but there are these special procedure rules that they're using, and maybe you can talk about those a little bit more as it relates to the proposal and how it's going to get through the system.
Yeah. So in the Senate, there would be 2 opportunities to make significant changes to the bill. If they mark up in committees, in the Senate, those committee markups they're not the wild, wild west, but many times they make clear whether there's a majority of senators who are interested in something, and the chairs of the committees seem to bend to the will of the majority or those on the committee. And then, of course, on the Senate floor, you can amend the bill. Unlike the House, which passed a rule saying no amendments were allowed, in the Senate, you can't do that. You'll allow amendments on the Senate floor. And in fact, there'll be 40 or 50 of them before we're done. Now, whether any of those pass depends on whether Democrats view this as an exercise to draw distinctions between Republican priorities and Democratic priorities, or whether there are some bipartisan amendments where they're actually trying to improve the bill in some way. But there certainly will be opportunities in the Senate to modify it. Keep in mind, though, that the reconciliation rules, if they move properly under the Senate rules, they are limited in terms of the topics. The germaneness rule is tighter on a reconciliation bill. You can't sort of add a new provision that has not been considered or is not in the base bill. And sometimes you just don't get to debate them very long. We have what's called a votorama at the end of the debate, where you can get a vote on your amendment, but you really don't get the chance to discuss it and debate it.
Well, so let's get into the provisions of the bill itself. And specifically, maybe you can both talk about the provisions that relate to family businesses. What provisions do they need to be concerned about? Michael, we'll start with you.
Sure. I think there's a lot in the bill that family businesses should keep an eye on or interested in. As we've already kind of mentioned, the House passed bill includes extension of many expiring provisions from the Tax Cuts and Jobs Act. In fact, it makes permanent several of those expiring provisions, including TCJA's individual income tax rates, the Section 199A pass-through deduction, which we know is important for so many family-owned businesses across the country. There's also an extension and an increase in the estate and gift tax exemption level. And I should note that there are several modifications to Section 199A as well, including an increase of the deduction to 23%. Those are the TCJA provisions. There are also a trio of very sought-after business provisions that were included in the bill that Congress attempted to address last year at the end of the 118th Congress in a stalled bipartisan bill. That includes 100% bonus depreciation, a return to pre-TCJA rules for interest deductibility, and also restoring immediate domestic R&D expensing. In addition to those, there are a few other provisions, including new expensing provisions for manufacturing structures that are priorities of President Trump's, and that the House is now claiming is bringing down effective corporate income tax rates for other businesses. But I think those are many of the key highlights.
Yeah, and Michael, I agree. And on the individual provisions on the rates and 189 Cap A and the state exemption and all, those provisions are pretty much at least as good as current law, if not better. However, on the general business trio that you mentioned, including bonus depreciation, I think the House only extended those through 2029, I believe. So they're there for 4.5 years. I think we're going to have a battle over the length of those. There are a good number of senators who believe that those provisions should be permanent, just like the other provisions from TCJA. How do you see that? Do you see the Senate actually making those permanent?
Yes, I think that's certainly a priority of the Senate. I think we've seen Senate Majority Leader Thune in recent days, since the House passed their version of the bill, call for those provisions to be permanent as well. I think overall, we'll see the Senate kind of take a magnifying glass to a lot of what the House has done, to make sure that aligns with the Senate's thinking as well. I think at the end of the day, Senate Republicans are going to be looking to maximize the growth, the potential of a lot of those provisions. And I think permanence is certainly a way to do that. As we know, it's very important for family-owned businesses and businesses of all shapes and sizes to have certainty in the code. And I think members of Congress and senators are very aware of that.
Well, I would echo that, Michael. And Russ, certainty and permanency is so important to family businesses because, as you both know, they plan their business as a legacy, not only for themselves and their employees, but also their community. I just caution people that, permanent is permanent until somebody changes it. So we've seen this happen before in our Congress. So while I think you should certainly plan and prepare that it's going to be permanent, be cautious and realize that it may change over time. You both talked about the income tax provision already, but maybe you could tell us, income taxes, both of you know, is a very important issue for family businesses because 80% of them operate as a pass-through entity and they're paying ordinary income tax rates. So who are the winners and losers in the income tax provisions contained in this one big beautiful bill?
Well, I think the winners are every American except potentially those making more than $1 million a year. And let me explain. So every American benefited from the TCJA by lowering the rates, expanding the brackets, and all those, increasing the child credit, all of those provisions. And so it would be the rare taxpayer who would come out better if the TCJA expired and was not replaced. I'm sure there are some who, for some strange reason, it might end up better, but 90+% of Americans would be better if the TCJA provisions are extended. The reason I had the caveat on the millionaires would be, I don't think they've finally resolved whether they're going to keep the top bracket at 37% and the amounts that kick in there at $750,000 for married, filing jointly, and lesser amounts for head of household and single. The House bill did not change it. There was no provision imposing a new tax bracket or a 40% bracket or anything like that. But there continues to be this discussion, and some Republicans who say, I'm not sure whether we should just keep 37 for everyone or we should have one more bracket at a higher level. Even Trump, 2 or 3 different times, has said, I think I might be okay with a higher tax rate for millionaires or people making $2.5 million or some amount. And so that battle is still raging. I think we believe that the top rate should be 37% for everyone, and we're working to make that happen. But I don't think the battle's going to be over until the bill's on its way to be signed.
Yeah, I think that's an important point because it could affect family businesses that are making over $1 million or $2.5 million or whatever that threshold is, Russ, because as I just mentioned, 80% of them operate as a pass-through. So if they have a business that makes over that threshold, they could be at that 40% bracket. So I'm so glad that we're educating members of Congress as well as our president around that very, very important issue. So the other issue that's very important to family businesses, and it's second on their list of priorities, is the estate tax. So, Michael, you might talk about this a little bit. Russ and I have had decades of experience around the estate tax, but tell us where it is right now and where you think it's going to end up in this one big, beautiful bill.
Yeah, so as we all know, TCJA's extension of the exemption level was temporary to the end of this year. In the House passed bill, the Ways and Means Committee is proposed to permanently increase the exemption level to $15 million beginning after this year, and indexes that increase to inflation in years going forward. Certainly is a welcome inclusion from the House. I think we were pleased. Russ, correct me if you're wrong, or if that I'm wrong. We were pleased to see that there was an increase in addition to just the extension of the exemption level from TCJA. I think we'll be watching this provision in the Senate, and we're hopeful that perhaps if there is some extra room in the Senate's instructions from a revenue standpoint, that there may be some additional flexibility, either in a slight increase from that exemption level, or perhaps a decrease in the rate. But definitely keeping an eye on it going forward.
Well, I think one thing's working for us and one thing's working against us on that point, Michael. The thing working for us is that the Senate has more flexibility in order to not have to fully pay for the tax cuts that are in the bill, because they're adopting a current policy baseline. So that means in the context of the estate tax, it assumes that the amount is the 14 million that it is right now. So in other words, they include a provision that increases it to 15 million. That's not going to cost very much on the sort of tabulation of how much this bill costs. On the other hand, we have some Republicans in the Senate, like in the House, who don't want the overall bill and the overall agenda for the Trump administration to increase the deficit. They're worried about the national debt level. They're worried about its impact on the economy. They're worried about depending on other countries to finance our national debt. And so even though they like the tax cuts, they want the overall agenda when you consider this bill, when you consider tariffs, when you consider discretionary spending cuts through the Doge group or through later appropriations bills, to mean that it's not a big increaser of the deficit. And I think that works against us to get another chunk of money dedicated to, say, reducing the rate, putting it on a downward trajectory, maybe a slow reduction from 40% down to a lower amount. That's going to make it hard.
So you've just addressed part of my next question, which is this is going to cost over $4 trillion. What are the ways? You've mentioned some of them. What are the other ways that they're going to try and pay for this bill or rationalize increasing our debt by $4 trillion? Either of you have any comments on that?
Well, first, keep in mind, the bill does have offsets. The House bill has a 1.5 trillion in spending cuts, and it's got 1 trillion in tax increases of various varieties. So they've got 2.5 trillion in, offsets, so to speak, in the House bill. Whether the Senate has that many or not remains to be seen, but I think they're going to probably come out with fewer tax increases, but more spending cuts if they can find acceptable spending cuts to the moderates in the Senate that really want to vote for a bill, but are not sure about some of the specific cuts that have been proposed.
I think you'll also hear many Republicans focus on the broader economic impacts of the bill. As with TCJA, I think we'll hear Republicans discuss the economic growth associated with tax cuts and preserving tax cuts. It's been a common refrain from Republicans in recent years that TCJA exceeded its goals in economic growth and associated revenue effects. There's a small caveat there for some of the COVID impacts. But I think we'll see Republicans, return back to those talking points about broadening the tax base and making the United States a viable place to do business and the associated wage, job, and economic potential from those provisions.
Yeah, I think if you add up the spending cuts the tax increases, if you include tariffs, which I think it's apparent now that at least some tariffs are here to stay for the next 4 years. No, Trump has not released the 10% base tariffs on any country that I'm aware of so far. He's negotiating on the amounts above that and reducing some of them back down to 25 or maybe to 10. But that's gonna generate trillions of dollars, maybe $2 trillion just on that alone. And if the bill is designed effectively to encourage economic investment and expansion, then there will be sort of this growth dividend of additional revenues that flow into the Treasury from more profits being made by more enterprises, including family-owned enterprises.
And perhaps a separate track here as well. We did briefly discuss the rules of the reconciliation process, but the spending cuts in this package are mandatory spending. There was referred to as direct spending. There is another bucket of spending. It's smaller, but it's the discretionary pot of money that Congress spends each year on discretionary programs. That's what most people are familiar with from a just general government standpoint, and that's where the so-called Department of Government Efficiency has been operating in the last 5 months. And we'll be seeing Congress, after the reconciliation bill moves through the House and Senate, kind of turn to some of those discretionary programs and including spending cuts there as well. I know we're also expecting the president's budget this week, which will include some proposals on additional cuts outside of the reconciliation package. So tackling the debt and deficit from that angle as well.
So my final question to both of you is, do you feel that family businesses should be, and family offices and successful individuals in this country, should they be optimistic about this bill? And if so, why? And if not, why not?
Well, I think they should be optimistic. It does extend and possibly make permanent a wide variety of the provisions that were important to family businesses in 2017 and remain so today. I am increasingly concerned on two provisions, Pat, that were included in the House bill. One is an increase in the excise tax on family foundations. It's more broadly on private foundations, but we're hearing from an increasing number of family-owned businesses who have had the opportunity to set up a foundation, and that tax rate, which is currently, I believe, 1.39% on the net investment income, would be increased to double that, or 5%, or even 10% for very large family foundations. Second, there's a modification to one of the provisions that was in TCJ that limits individuals' ability to offset business-related losses with other gains. And that put a maximum amount of $250,000 or $500,000 per couple for each year. There's a new provision in the House bill that says that those excess losses that you cannot take in a particular year cannot be used in subsequent years as a net operating loss. In other words, you have to just sort of save them as an excess business loss. And if you have years where you don't have such losses, you can use $250,000 or $500,000 in the subsequent year, but not get the tax benefit of those losses near as quickly as you can under current law. And so family businesses ought to be looking at those two provisions, and we hope to reduce the pain of those provisions in the Senate. And if those are significant, that could offset some of the benefits of the other provisions in the bill.
Russ talked about proposals within the bill. I think I'll talk about maybe optimism for final passage. I know that a lot of us were disappointed that the bipartisan bill in the last Congress failed in December, and the associated benefits of retroactivity and some of the other provisions weren't seen, especially on R&D and expensing. But I think now we see President Trump very active and engaged in this process. I think House and Senate Republicans are very, very eager to have a legislative victory for Congress and for the president before the end of the year, before the end of the summer, realistically. So I think we're going to see this process being steered by President Trump, and I think they're going to keep working at these issues and these lingering policy disagreements over the coming weeks, and get to somewhere where everyone can be a yes at the end of the day. So I'm optimistic that we'll have a bill. It might not be by July 4th, but I would put my money on by the end of the summer at this point.
Well, that's very helpful. I'm glad you brought that timeline up because I think that's important for people to know. And Russ, I'm glad you mentioned the net operating losses and the excise tax on private foundations because that absolutely affects many of our family businesses. So do either of you have any final thoughts you'd like to share with the listeners today?
I would just say that I agree with Michael. I think it'll get done at the end of the summer, but keep in mind, some of these provisions are going to be retroactive back to the beginning of the year. So if they increase the child credit from $2,000 to $2,500 or $3,000, that will be retroactive. The bonus depreciation, interest expense, R&D would be retroactive to the beginning of the year. And so watch closely on the effective dates of these provisions. It may help you in the financing of a new project or mean that you're likely to get a refund for the year 2025 because you've had a little too much withheld if you've got a paycheck. So those are important considerations too.
I'll just say, the process doesn't end with final passage. There will be an implementation period for many of the provisions in the bill, especially the new provisions at the Department of the Treasury, and Treasury Secretary Dissent will be leading those efforts. There will still be opportunities for things to be adjusted or modified through the regulatory process. But now is the time, I think, to take a look at provisions in the bill and communicate concerns or positives to those involved, and let us know exactly what you feel is important in the package or what's troubling to you.
Yeah, I would echo that. Let us know, and also let your legislators know what you care about in this bill, what's important to you as a family business owner or a family office or successful individual in this country. They need to hear from you. This is a really, really important, critical year. So I would really echo that remark from Michael. So I want to thank both of you for participating in this podcast today. It's been a pleasure. It's been very informative. I know it's incredibly valuable information for our listeners. We hope you liked today's podcast, and if you did, please subscribe. With each episode, we discuss the critical issues affecting family businesses, family offices, and successful individuals in the country. You can find this podcast wherever you download your podcast. Until next time, thank you for listening.